Danielle, tell us, yeah, I mean, just underscore for us why the Fed won't be able to do what it thinks it can do.
Well, if you look back to April, which was when the third stimulus check was sent out to most Americans, that was when we saw the difference between the 2-year Treasury yield and the 10-year Treasury yield at about 160 basis points. It's post-pandemic widest. We've since cut that in half. And so the risk going forward is that we continue to see this rapid flattening of the yield curve, which tends to flag signal a slowing economy. And indeed, if you look at what's going to occur, because there has not been any subsequent legislation passed, there's a very good chance that the United States, that many households in the United States are going to go over a second fiscal cliff between now and January the 31st.
But is inflation going to change in any way in terms of the outlook next year? I mean, once we have the base effects, that the stimulus boost starts to fade as well. I mean, I'm just wondering, does the inflation picture force the Fed to continue on, or does it change?
Well, that's a great question. You know, we saw the largest increase in food subsidies to American families since the program was first rolled out, a 32% increase on October the 1st. And that level of monetary support going to millions of U.S. families has pushed up food inflation to a much greater extent than what you see globally. And that is, again, it's a massive increase in something that is absolutely not in the Fed's control. At the same time, we are starting to see supply chain disruptions come off. General Motors, for example, has just added an overtime shift. We know that the semiconductor situation is beginning to be alleviated, and we've also seen car sales in America 7 out of the last 8 months decline. And you're hearing that Americans who are applying for credit to purchase cars, that those applications are down for financing 30% year over year. These are some big numbers that we're seeing that suggest that a lot of the goods demand has been pulled forward. And again, I mentioned that second fiscal cliff. Without subsequent legislation, December the 15th is going to mark the last time that American households got their child tax credit in cash. That's an average of $550 per U.S. household, a higher number if there are more than 2 children in the household. In addition to that, on January the 31st, we're going to see a lot of American families be surprised that they're not going to be getting the income tax refund that they're expecting, because they have been getting the credit in the form of cash since July, and then student loan repayments are going to be starting again on February the 1st. 3 different sources are going to be a crunch for many households that's going to temper the amount of their consumption.
Well, it seems the picture you're painting for next year would be something akin, and tell me if I'm wrong here, something akin to stagflation-like conditions in the U.S.
I think that is what the Fed could be grappling with. And mind you, regardless of the central bank around the world, there are no tools to combat stagflation. If you have an inverted yield curve, by definition, you cannot raise interest rates. And yet the Fed could be faced with such a dilemma. We also have a huge union contract coming up for renegotiation on June the 30th at the Long Beach and the Los Angeles ports, where we've seen so much of the source of supply chain disruption, the source of sky-high freight costs, and every single time since 1990, excuse me, that particular union has gone on strike. So if that happens again, you could again see Americans without the means by which to consume as they have in the post-pandemic era, but at the same time, companies faced with continued margin squeezes and artificially high food prices, because again, food subsidies have increased by 32% since this last October, and you see it like a hockey stick, whether you're talking about meat prices or poultry prices or dairy prices that have just gone completely skyward since October the 1st, and that's because so many people are getting so much more money subsidized by the government in the form of what we call the SNAP program.
So if you think that the monetary policy is not exactly going to be, I guess you're not being able to hike, what are you seeing on the fiscal side? What needs to happen to support that scenario that you're talking about?
Well, I think we obviously need a lot of these subsidies to not go away, even though, to be fair, the federal government cannot do anything about income tax season, and millions of families who are planning on getting $2,000 or $3,000 who are going to get quite the surprise on January the 31st when the IRS first begins to accept applications for income tax returns, and they find out that the money that they were going to use to pay off their credit card spending from Christmas is not there, or what they were going to use for a down payment on a car or to take the family on vacation. So that's going to be a major shockwave that runs through the U.S. economy, again, with the lowest income earners with the highest propensity to spend money once it hits their accounts. So Joe Manchin is arguably continues to be the most powerful man in America because he's holding the line on further fiscal stimulus, saying that we need to step back and appreciate the inflation that has already been generated by overly aggressive fiscal stimulus. So we'll have to see if he continues to hold the line.